G'day Fools, I'm Scott Phillips, the Motley Fool's Chief Investment Officer here in Australia, and thank you for joining us yet again for another episode of Motley Fool Stock of the Week, where we pull the curtain back on one of our recommendations and give it to you for free. On both YouTube and our podcast, we share with you what it is, why we like it, the risks, and of course, why we think you might want to consider buying it right now. Now, I use that phrase, why you might want to consider, very deliberately. We can only give you general advice, not personal advice. We can't tell you what's right for you specifically, for your needs, objectives, goals, and circumstances. All we can say is we think a company is likely to be a market beater in our opinion, then you need to decide whether it's right for you. Now, speaking of market beating, we are long-term investors. We make no predictions over the next hour, day, week, month, or even year. We're looking at 3 to 5 years and beyond and trying to find the long-term compounders that can have a material impact on building the wealth you're looking for, hopefully earlier than retirement, but certainly in retirement and well and truly thereafter as well. And while I'm on a roll, the third one, this of course is being recorded in the middle of February 2022. If you're watching this or listening to this any later than that, just be mindful that we can and do sometimes change our recommendations based on circumstances, price, value, competition, quality, all that sort of stuff. So it's our view now, right now, but please just bear in mind that it can change from time to time. All right, with all that out of the way, let me bring you today's analyst extraordinaire, Trevor Muchedzi. G'day, buddy. How are you?
Good day, Scott. How are you?
Mate, I'm exceptionally well. I'm very excited that you're here to bring our podcast listeners and our YouTube viewers a company that I'm going to say, mate, I am clearly not as smart as you because I have missed this one the entire way through. So I'm going to get you to educate me as well as educating our listeners and viewers on a company called Lovisa, L-O-V-I-S-A. The ASX code is L-O-V. I'm going to say, mate, I have never, ever, ever set foot in a Lovisa store. I don't even do that much shopping. So maybe you can help me out and assume you can help at least a few of our listeners and viewers out. What exactly is Lovisa?
Well, Scott, I'm not quite surprised that you've never set your foot into a Lovisa shop. Maybe I don't think you are the target. You're the target market, but
probably good for them mentally. I imagine.
Yes, definitely. I mean, the company Lovisa is like a vertically integrated specialty retailer that focuses on affordable jewelry, right? Okay. So they only focus on affordable jewelry. So if, let's say, someone wants to go to a party or a function and they need, some nice earrings, some nice necklaces, but something that's really affordable off the shelf, they go to Lovisa. So that's their target market. But the business model, right, really is what we normally call a vertically integrated retailer. What that means is that they design, they source, and they merchandise their Lovisa branded products. So they only sell Lovisa branded products in their shops. The actual manufacturing itself is done in China, but in terms of the design of the products and the merchandising and the sourcing of products is done in-house. So the company really, the way it works, I think a very good example of such a business model is with a company called Zara, which is one of the most popular specialty retailer that focuses on fashion. So they've got almost a similar business model, but they focus on affordable jewelry.
I like it, mate. And Lovisa is one of those businesses. Again, I don't live in the city. I live just out of the city. So I don't even think I've literally physically seen a Lovisa store, certainly not for years. It's done an amazingly great job of growing. I don't know if you have the store count handy, but it's blown itself up in Australia. And then overseas, it's a really, really, for me, I would have thought a really specific, very small niche. But I guess that's the thing. If you dominate, you can do really, really well. Do you have a sense of the geographic footprint, mate, just for a bit of information for our viewers and listeners?
Yeah. So the company, like you said, Scott, this is a really successful Australia/New Zealand type of play. They've got something close to 153 plus or minus like stores within Australia and New Zealand, right? And I think in some analysis that we did, I think within our specific market, the optimal side in terms of footprint is around 160 stores. Okay. After that, really, you start cannibalizing yourself. So they're almost reaching like maturity levels within Australia and New Zealand. So this particular company, why we like it, is exactly what you said. This is an international growth story. Right, okay. So they want to replicate this model to go to the international market. So what they've done is that around the peak of COVID, which is around 2020/2021, they acquired a German, again, fast fashion jewelry retailer, a German company, and they paid like 80 euros for that acquisition. Not 80 million, 80 euros for that acquisition.
Okay.
Because remember that at the peak of COVID,
Oh,
right?
right.
At the peak of COVID, most physical stores were, they were shut down for an extended
Right.
periods. So most physical retailers, they were struggling across the entire world. So they managed to buy this company in German, and that gave them footprint across 7 European countries. So they are going to spend something around 6 million euros in terms of, rebranding and restocking all these all this the exposure that they get in these 7 European countries. I think it's a total count of around 115 stores. So they're going to spend 6 million euros to refurbish and restock this with and rebrand to Lovisa. But essentially what they want to do is they want to replicate the successful model in Australia and New Zealand, and then they want to take it overseas.
It's an amazing story, man. I'm going to ask you a question by way of identifying and focusing on my own ignorance. When I saw the Lovisa story, I got it was growing quickly. But I guess my first thought was, how big can it really get? The other one, I guess, was I'm not even sure I still know. So I'm asking you literally to help me out here. A business like Lovisa seems to me to have almost no competitive advantage, right? The idea of the fast fashion, the costume jewelry or affordable jewelry as they call it, you and I could get together, and maybe not you and I and someone else, well, you may have more fashion sense than me. I'll make it about me. I couldn't start Lovisa tomorrow, or competitor tomorrow, but I figure someone else could. And so my concern was always, what's the secret sauce here? Why does it have the ability to grow so fast? Why is it a sustainable business that couldn't just be simply replicated or replaced tomorrow? What's the secret sauce that I'm missing when it comes to Lovisa?
So the secret sauce, Scott, the way I think about it is always, I think the best example is Zara, right? So the secret sauce is that Zara and Lovisa, they've got one thing in common in that they can spot a fashion trend, and from the time they spot it, they can bring the product on the shelf within between 10 to 20 days. Right, so they've got this supply chain, which is really amazing, because if you look at other fast or other retail shops, like when you're in the fashion or jewelry, it can take 6 months between coming up with an idea and then merchandising and bring the stuff on your shelves in the store. But for these guys, I think Zara were the pioneers in this space. That's why Zara as a company is one of the most successful fast fashion retailer, because they can spot a trend and bring it on the shelf within 10 days. So it's a remarkable supply chain that they've been able to build over the years. So I agree with you in terms of conceptually, right? You can say, we can replicate this model, but maybe in practice, you might find it much harder to replicate than it is like in theory. So therefore, that's the similar approach that Lovisa uses, right? So, and really, if you think about it, right, if you think about the bull case for Lovisa, it's all about, maybe I can call it Instagram and TikTok. That's the bull case, right? So you have got these young millennials and Gen Z, there's something that's fashionable, whether it's an earring or whether it's a necklace or whether it's a design for a particular, any jewelry, that is trendy at that particular moment, right? So when something is trendy, people want to get their hands on it in 10 days, in 1 week, not to wait for 6 months for something trendy, right? So that ability for them to be able to deliver trendy, affordable jewelry on shelf within 10 to 20 days,
that's remarkable. Mate, my trends are about 10 to 20 years, so I'm probably a little bit off the pace with Lovisa. Maybe I won't start a competitor anytime soon. When it comes to let's go back to the international story, because as you say, 150-ish stores in Australia, you reckon the maximum is about 160. So I'm going to say, based on what you're saying, and tell me if I'm wrong, the Australian-New Zealand business is pretty mature. It's kind of, maybe even hopefully it's a cash cow business, or at least it's a prototype business they can take elsewhere. They've already bought the German business, so they've got 115 odd stores there. Is this a business coming towards the end of its life, or has it still got multiple legs to go? What does the international future look like in terms of Lovisa's compound opportunity moving forward?
Yeah, so Scott, I think that's a very, very good question. So the way we think about Lovisa is like this. So you have like an Australian business, right? Australia/New Zealand business, to your point, that is really mature. Prior to COVID, right? The profit margins, net profit margins on this business, the Australia and New Zealand, was around 16 or 17%.
Remarkable.
Which is extremely high for the retail. And if you know, for the retail sector, you're looking at 3% plus or minus, or 4%. So if you're doing 16%, it's extremely, extremely high. If you look at the return on invested capital, I think it was around 60%. Again, extremely high for the retail sector. All right. So you've got this nice cash cow, from the Australian and New Zealand business, which is mature. And if you look at the company's P&L, they have been making a lot of profits over the years. So what they did is that they, I think in 2021, which is last year, they appointed a guy called Victor Herrero, who was the former head of Zara. He worked for Zara, he worked for Guess, and then he also worked for Clarks. And also, these are fast fashion retailers. So, and he was responsible for those businesses within China and India. So he has extensive experience in terms of developing fast fashion in those two significant markets. So they managed to do a coup and recruited him to become the CEO for Lovisa. So to answer your question, right, the way that we are thinking about the international opportunities is twofold. Number one is these opportunities to really take advantage and be counter-cyclical, like what they did with Germany, because the European market is quite mature and developed. But a lot of these specialty retailers, they were struggling during the COVID when there was an extensive shutdown of stores. So they've got that leg, right, that they've entered those markets through the acquisition of the German company. And then there's also the opportunity to expand into China and into India, right, and take this fast fashion mentality, really, which is to a large extent driven by social media, because then people want to post, or whether it's Instagram or TikTok, they want to post, and they want to post looking good and with some fashionable jewelry. So those two markets are quite expensive markets. We're talking about something close to 2.6 billion or plus or minus more people in those combined markets. And Victor has extensive experience, especially in those two particular markets. And then the last thing is that the way that Victor's remuneration structure is structured is that he only gets to make money if he quadruples Lovisa's net profits over the next 3 years. So that's only how he is going to get paid. So there's also this alignment, or I think on his end, he's also quite comfortable in his ability to quadruple profits over the next
extraordinary story if they manage to do that. And I can see why that's an attractive investment opportunity. It's interesting, mate, as you're talking, you mentioned Europe being a mature market, and I reflected that Australia itself was also a relatively mature market when it comes to costume or affordable jewelry. And it's the breakthrough that you've highlighted. I didn't even think of this before our chat, so I'm glad we talked. The idea of kind of using social media as the innovation. There's nothing new in retail generally speaking. I mean, the fast fashion idea, the supply chain stuff is obviously great, but the opportunity to say, hey, we can find it, build it, and bring it to market. Even in what's more mature than kind of jewelry, right, or costume jewelry? There's been a million of them around forever. This wasn't exactly an underserved market. It had plenty of people. You could buy plenty of stuff. But if you can build a brand around being right and being quick and using that social media, I can see why you say, well, hang on, Europe's a mature market, but if we can go in there and bring better stuff more quickly, we can undercut the incumbents, both in terms of maybe price, but certainly in terms of speed, and become that kind of go-to. If I see it on TikTok, I know I'll get it at Lovisa. It's a pretty cool story. That's pretty awesome.
Yeah.
But let's go to the risks in a second. I'm going to get you hold for fire 1 minute while I do a quick ad. Because, as always, the Stock of the Week episode is being, I like to say simulcast because it makes me sound like I'm doing the fireworks in 1993, but being broadcast across both YouTube and our podcast channel. So let's go through those. If you're listening to the podcast, that's Motley Fool Money. Thank you for doing that. Please jump onto our YouTube channel as well. Just go to youtube.com/C, I think C is for channel, /C/FoolAU, or just simply search for the Motley Fool Australia on YouTube. You can find us there, and you can see Trevor and myself have this conversation, plus a whole lot of other stuff we post to the channel really regularly. I'm not going to give too much away, but Trevor and I have a series upcoming that I know you're really going to enjoy. Trevor's already thinking about 2 or 3 episodes worth. It's going to be fantastic. So jump on the YouTube channel, subscribe, and hit the notification bell if you wouldn't mind. Also, by the way, if you're on the podcast, check out The Good Oil with Scott Phillips, which is our other podcast. Some really great stuff there as well. If you're on YouTube, of course, check out the other two, Motley Fool Money and The Good Oil. You can get so much good stuff from the Motley Fool. We are on all of the planets. We're on YouTube and we're on podcast. We're on socials. We just spoke about socials. I'm not on TikTok. I am on Instagram. I'm also on Twitter. You can get me there at TMFScottP. You can get the Motley Fool on both those platforms at the Motley Fool AU. And Trevor, you're, I think, at Trevor Muchedzi on Twitter. Is that right? Excellent. Got that out of the way. Yep. If you're on Facebook, you can also find us facebook.com/Scott Phillips Money or facebook.com/The Motley Fool Australia. As I said, it's all free from the Motley Fool, including this episode and one every single Wednesday, where we give you one of our recommendations. We pull back that curtain, as I said. All right, mate, let's move on from that. Let's get to the risks, because as I say almost every week, we always want to make sure that we share the risks of an investment with our members. We recommend them because we think they're a good chance of being market beating, but we also know occasionally we make mistakes or things just happen, right? We can't know the future with certainty. So we try and find the best, highest possible return, given the risk, given the potential return. We say, yep, we think you should buy those shares, but there are things that can go wrong. That's also the case with Lovisa. So maybe, Trevor, you could share with us some of the risks of an investment in Lovisa for us.
Sure, Scott. I think what we have seen, at least in the last 6 months or last 12 months with Lovisa, is this continued impact of the lockdowns. All right, because Lovisa, of course, is an omni-channel type of a retailer, so they sell both online or offline. But jewelry, if you think about it, is really like a product discovery type of the category. So people want to walk into the shop, they want to try various jewelry pieces before they actually choose one. So the company has been heavily affected by the lockdowns, right? And it has been a curveball. Everybody thought everything was going back to normal, but in December with Omicron. So this continues to be a risk in the short to medium term, because we really can't tell how these lockdowns can evolve over time. And then the second one, which is one of the most critical issues right now, is around supply chain. Obviously, so many companies, Lovisa is not an exception, they're also being impacted by supply chain. So that ability, because the actual manufacturing is done in China, so that ability to be able to source and merchandise their products really at the moment it has been extremely quite difficult. So we expect these headwinds also to continue into the short to medium term. And I think another key one is around like labor costs, right? Which right now or labor shortages, if I can probably like position that way. So we are seeing these labor shortages continuing. Again, this is linked to COVID. Right now, we are seeing across the world that it's quite difficult to get employees within specific categories. So these labor shortages are also pushing up costs in terms of operating costs. So in the last 6 months or so, we've seen the company's net profits decline substantially. Like I said, prior to COVID, they were doing around 16%. Right now, I think in the last 6 months, the profit margins are something close to 9%. So it is one thing that we have to continuously monitor. It's extremely difficult for us to tell, how this is going to play out until the issue of, at least until the risks associated with COVID have gone down. So it's one of the things that we should continue to look out for.
Yeah, it's a really good point, mate. I've said before that it's actually, perversely, if we like that sort of thing, and you and I do, it's a great time to be an analyst, right? Because normally in a normal environment, even during recessions, you can kind of, things move in relative waves. You can kind of forecast forward a little bit. We don't tend to make predictions at the Motley Fool, but you kind of think, okay, well, if a business is growing, it's probably going to keep growing. Those things are relatively straightforward. If you think about COVID, we haven't had a clean financial year, full financial year, since fiscal 2019. We are now coming up the second half of fiscal 2022, and this is still not a clean year because of those lockdowns you mentioned. Fingers crossed for everybody, including health and society, that 2023 is a clean year, but that'll be 4 years between clean years, and it makes it very, very hard to look at a retail, any business, but particularly retail, and try and work out what of their numbers is cyclical, what is structural, what is literally one-off because of the COVID impact and lockdowns, as you say. So it makes it fun, it makes it interesting for us, but it certainly does make it harder to be certain, particularly some of these, even when Woolies gets 10% sales growth. I mean, that's a staples retailer. And then you look at a discretionary retailer like Lovisa, and it makes things much, much more difficult The good thing for our members and the good thing for our viewers and listeners is you are on the case, Trevor. I really appreciate that. So, mate, let's wrap this up. Let's my patented, not really, elevator pitch from the first to the 31st floor. You got about 30, 60 seconds. Lay down for me the case for buying shares in Lovisa.
Well, I think the case is Lovisa is one of the few specialty retailers that is extremely profitable, at least in a steady state. If we look at the last 5 years prior to 2019, which is when we had the last clean fiscal year, they've been doing net profits, 16% consistently. So it wasn't like a once-off. So if you look at 5 years prior to that, they've been doing 16% net profit. They're having return on invested capital around 60%, which is again quite extensive. So it is a really profitable fast fashion retailer. So that's the first thing that we like. The second thing is that there is a great alignment because the chairman of the company is the co-founder, and he owns about 42% of this business. So he's heavily invested in this business. And number three, they recruited someone that we believe is the right recruit to be the CEO, given his extensive experience, right? So we believe that a mix of these factors, really there's a compelling case that you're looking at a business that it for now is going through some pains, but I think in the long term it's a business that can be highly profitable, and that growth opportunity in Europe and also in India and China, I think it provides extensive growth opportunities for the company going forward.
Beautiful, mate. Now, as we always say, when we bring the stock of the week to you, we're not saying bust just buy this one stock. There is risk with every single company on the ASX and right around the world, but we think Lovisa is a company that can form part of your portfolio. If you understand the upside, you understand the risks, you'd get your head around the business. And I've got to say, mate, I am much better informed at the end of this video than I was at the beginning. I love the social media kind of opportunity and also the supply chain expertise and frankly just straight out speed. Really, really impressive business. I'm going to have another look because maybe it's time for me to buy some shares. I'll see how we go. So if this will have to go to air first, I can't do it until this goes to air. In fact, I can't do it for 2 full days after that. So if I do, it'll be a little while. But, mate, I really appreciate you bringing that to me, but more importantly to our viewers on YouTube and our listeners via the Motley Fool Money podcast. Trevor, thank you for sharing your expertise, and to viewers and listeners, thank you for spending your time with us. You can spend your time however you want, and we appreciate you spending it with us. Hopefully we've delivered way more in value. I'm pretty sure Trevor has delivered way more in value than the time you've given up to listen and watch, and we really appreciate it. So on behalf of Trevor, myself, and the whole Motley Fool team, until next time, Fool on.